You can't just be thinking their stock's at $400, can it get to $600, can it get to $800? Zoom has had a crazy year in 2020. They've benefited so much from the shutdowns, from the work from home. And when we look at Zoom now, let's put some of this into perspective a little bit. Zoom is actually now worth more than Boeing, okay, when we look at their market cap. Zoom is worth more than Uber. Zoom is worth more than Starbucks, than Square. And I think, that for a lot of these companies, that was not the case before the start of 2020. And do we really think that that's going to be sustainable? Hey everyone, Paul here. Welcome back to the channel. And Zoom was down 17% today. And this came, with the Dow having a record day. A lot of stocks were green. And this was really driven by the news with Pfizer having a vaccine that had really promising results so far. And again, so the market responded really, really strongly. And this was already, on the back of kind of a strong election week response from the stock market. So all of that being said, you had Zoom down 17%. So just in the sense that most stocks are actually going to be benefiting from the world returning to normal if there is a vaccine, well, Zoom is not going to benefit if things return to normal. Okay, so that has investors a little concerned, but we can also put that 17% decline in context because Zoom actually went public in April 2019. And since they went public, even with their recent 17% pullback, they're up 560%. Okay, so obviously a huge increase. And we can kind of break that down further. We can understand that 500% of that increase was a result of 2020. Again, so Zoom has been a really, really hot name. And I know the question has been on a lot of investors' minds to say, okay, is this 17% correction? Is this the start of a pullback? Is this going to be a pullback on the way to another rally higher? Where do we go from here? Okay. And so I'm not really into technical analysis. I'll leave the charts to somebody else. But what I can talk to you and what I can kind of lay out for you is my own opinion, of what I think the valuation is based on the actual fundamentals. So when we look at sales growth and we're, kind of forecasting some of those things out, we can start to get a good idea of how much this company would have to grow, in terms of sales over the next, let's say, 5-10 years to justify where they're currently trading at. And because when we think about this, Zoom is a stock that, has a very wide range of analyst price targets. There are analysts out there that have a price target on this over $600. There are also some analysts out there that have this price maybe closer to $150 a share. Now, I think when you really get into it, the analysts that actually are pricing it at around 150 are really doing it based on, some of the fundamental indicators. I think sometimes when you have a stock just running up by 500%, I think some analysts can kind of get carried away and kind of just think that that's going to continue and continue and continue, which is not always true. With that in mind, what do I actually think about the valuation of this? Well, let's get into the model. And I've used this model to cover, Asana, DraftKings, some other companies that I think were growing really, really quickly and were not really necessarily profitable or had any kind of meaningful profit at that point in their growth phase. But we can use that model to take a look at Zoom. So let's go ahead and get into it right now. We take a look at this. Again, we have our share price in the upper left-hand corner, so our $413. We also look at their market cap, which, by the way, their market cap is over $117 billion. Let's put that in perspective. Okay, so that means that the market is valuing Zoom more than Starbucks. They're valuing Zoom more than Square, more than Uber, more than Boeing. Okay, so there's a lot of established companies out there that Zoom has, just kind of really left in the dust as far as, quickly overtaking them with their market value. So we have that to think about. Also I have listed here, so they actually have already reported their results for 2020, but it's their fiscal 2020. So when we look at their revenue for fiscal 2020, they had $623 million in revenue, and that was an increase of over 88% from their fiscal 2019 when they had $331 million. Again, when we look at their free cash flow per share, really small relative to what their valuation is, or what they're currently trading at least. But they had free cash flow of 49 cents per share in their fiscal 2020. When we look at their profitability, they actually made $25 million in fiscal 2020. So again, keeping in mind, their market value of their equity 117 billion, they made 25 million. So again, big difference between those two numbers for sure, but at least they are actually making money, which again, a lot of companies in this phase that Zoom is in are not making money. So at least that aspect is promising. But then what we can do here is we can start to kind of model some of these things out. So we can say, okay, if most recently their year-over-year change was an 88% growth, we could kind of say, well, what do we think growth is going to do from here? And let's say we expect it to stay elevated. So let's say that we're going to plug in our year one growth at 80%. Okay. And then let's say by year two, we expect them to kind of cool off a little bit and they grow by 40%. And then through years 3 through 10, that they maybe, just grow by 30% year over year through that time period. Well, then that would mean, by the way, that in 2031, for their fiscal 2031, that they would have grown 15 times in terms of sales from their fiscal year 2021. 15 times sales growth, okay? So, and that's what would just be implied just from the simple numbers we plugged in. We can change some of these to see what that would amount to as well. But if we do that, we would find out that they would actually be worth, in 2031, about $526, okay? Again, with the way we currently have this plugged in. But then that would mean that you would be waiting basically 10 years to turn $413 into $526. And is that a great deal? Well, we can actually take a look at that. There's this nice formula. So if you go equals in Excel RRI, it says it will return an equivalent interest rate for the growth of an investment. So what's our growth? We're going to say that our number of periods is 10, and in 10 years, we're going to have 413 turn into 526, and we find out that that would actually be an annual return in this case from the 413 to the 526 of about 2.5%. Okay, so that's not great. Again, we can put that in perspective when we think about the average of the S&P 500 being around 9 or 10% a year. So again, you could have the S&P 500, which again is of course going to be a more stable investment, giving you about 9%. And with this scenario of saying that their next year that they grow by 80% in sales, and then 40%, and then 30% from years 3 through 10 in our forecasted period here, which again it's just really, really strong growth. I can't understate that enough. For a company in 10 years to grow by 15 times, that is not a given, especially when we consider the fact that they have really strong, commercial competition from Microsoft and really strong commercial competition from Cisco with their WebEx. Okay, so certainly there are still enterprises that are using the Cisco solution, that are still using Microsoft solutions, and of course that there can be other competitors that could be lured into this market as well, because even right now it's actually estimated that the industry is valued at about $43 billion as far as the video conferencing and being able to sell that service to businesses. So it's about a $43 billion market, and most recently Zoom took about 623 million of that. Okay, so again, certainly there could be new competition related to this. But in this, by the way, also when we actually look at this, we're also assuming that this, by 2031, that they'd be trading 9 times sales, because and we can see how sensitive that return is, because even if we bumped our price to sales in 2031 in saying that investors would be willing to pay 8 times sales instead of 9 times, well then all of a sudden we would say in 10 years Zoom would be valued at $468 a share. Okay, which would actually be then for that 10-year period an annualized return of 1.3%. Again, not a great return. But now let's put it back to the 9 times sales. So let's say, hey, investors are still going to, put a pretty strong premium on this in 10 years. Let's make that assumption. But let's say that, even in years 3 through 10, then instead of averaging 30% growth, they average 20% growth, okay? Which would still leave them, in the course of 10 years, increasing their sales by 7 times. So in that particular situation, you would say that at the end of 10 years, their shares would be worth about $256, which would actually, of course, be a net loss or a negative return to shareholders compared to where they're currently trading. And again, that would be, 20% growth sustained for 7 years on average for a company. That is still really, really strong growth. And I understand Zoom, they've had some unbelievable quarters. I think that the business environment that they've been operating in has been very favorable. One aspect is that, or one line of reasoning says that they, have kind of accelerated a trend that was going to kind of play out anyway. And I think that there's maybe an argument for that, but for me, when I'm looking at this company, I just can't get anywhere near the valuation that they're currently trading at. I just can't find a situation where I can model that out. And again, I'm not the only one to make that assessment. There have been other analysts I've been reading about that have came to that same conclusion. And by the way, I think that, what's also kind of interesting to kind of think about, of course, with investing is that, you don't have to always go with these uncertain companies. And for my own investing kind of strategy and philosophy, I feel like I'm primarily going to want to focus on companies that are out of the spotlight. So I want to focus on some companies where I can say they're generating enough, free cash flow, consistently generating free cash flow, where maybe I can say that their valuation maybe is $35 and they're currently trading at $25. And I've got some stocks on my watch list and some stocks that I currently own that actually meet those conditions. And I feel much, much more excited about some of those companies versus trying to chase some of the really, really strong growth from Zoom. Now, that being said, I feel like I still do like, kind of modeling it out in this way, because if we would have started to model this out, and said that Zoom could have actually had some strong growth, back around their time of their IPO, I really don't think it would have been that hard to use a model to say that they probably could have been worth at least $100, which certainly when you were having an opportunity to get them to 68, maybe that makes more sense. But again, current prices, current situation, I'm staying away from this. I wanted to walk through why I want to stay away from this. And I think that as investors, the more we can actually kind of connect the actual business to the stock, kind of like I've laid out here with this revenue model, I think that's going to make us better investors. And so love to know what you guys think about this analysis, what you think about Zoom. If I'm crazy, you're going to keep buying anyway. You're absolutely thinking that it's just going to be a temporary pullback and they're going to take right back off again. Or, whatever you guys think, let me know in the comments below, and I will see you in the next video.